You'll get to know the 10 worst assets keeping you poor, and these might sound shocking at the beginning, but these are really making you poor, and you must watch this video till the end. Now let's start. Number 1. Penny stocks. Penny stocks may appear to present a low-risk option, but they are seldom a viable investment choice. With shares priced below $5, and some even as low as 20 cents, the valuations of these companies are subject to constant fluctuations. There is potential for significant appreciation within a short time frame, indicating a favorable return on investment. The challenge lies in the fact that assets hold value primarily when there are active buyers in the market, which can be particularly difficult to find with penny stocks. Diversifying your portfolio is essential, as concentrating your investments in a single stock can lead to significant risks and actually makes you poor. Number 2. Business partnerships and loans. When establishing a business, it is essential to secure investors who can supply the necessary startup capital. Typically, these individuals are close friends or family members who provide a specific amount of capital in exchange for an equity interest in the business. Should the business thrive, it may yield significant returns. However, it is important to acknowledge the elevated risks involved. When expenses surpass sales, it is the stockholders' equity that experiences the initial impact of a loss. Another possibility is a debt investment, where funds are loaned rather than invested, providing a more detrimental option in the event that the business fails. Because if you take a loan, your liability becomes unlimited and your personal assets may also be sold if you become insoluble. Thus, this amount of money becomes a liability, and thus you may become poor. If you take personal loans or credits, you are also making yourself poor. Subscribe to our channel and also press the like button to know more tips on personal finance. Number 3. Excessive spending on a home. While securing a place to live is essential, it's important to ensure that your purchasing decision is not overly influenced by the property's potential resale value. Real estate tends to increase in value over time. However, it is important to note that it is one of the few assets that necessitates ongoing financial commitment. Even with a significant increase in the selling price, the monthly expenses for taxes, insurance, interest on the bank loan, and utilities are likely to diminish any potential profits. There is a possibility of being compelled to sell during a market downturn due to urgent circumstances, which could result in a significant financial loss. Assessing the neighborhood prior to making a move is always a prudent decision. It's important to approach this with caution and not rely on it as a guaranteed source of income. Number 4. Initial public offerings, IPOs. Many individuals aspire to invest in the next big company, similar to Amazon or Microsoft. Regrettably, the companies previously mentioned stand out as an exception to the general trend. When a company goes public, individuals have the opportunity to invest by purchasing shares, with the aim of potentially realizing a profit through future trading. It's important to understand that a company's decision to go public doesn't necessarily indicate its financial health. In such a case, the only reliable way to secure a return on your investment is to already hold shares before they become available to the broader market. Frequently, you may find yourself missing the opportunity to invest at the right time, resulting in shares that could depreciate significantly within a year. The real winners in IPOs are often early investors, like venture capitalists and insiders, who buy shares before they hit the open market. By the time retail investors get access, prices may already be inflated. In many cases, IPO stocks decline within the first year, leaving investors with losses rather than profits. Number 5. Jewelry. Experience has shown us that diamonds possess remarkable longevity. While that perspective may not be entirely accurate, as all assets depreciate over time, anticipating a piece of jewelry to yield a return on investment can indeed seem like a prolonged wait. The true value of jewelry, much like a fine piece of art, becomes apparent only after several years. Gems, diamonds, and jewels typically see an increase in value after approximately 20 to 30 years, at which point they may be regarded as antiques. It is advisable to acquire items that bring you personal satisfaction rather than viewing them solely as a financial investment or a material to flaunt in front of others, or you may become poor for sure. Number 6. Currencies. Before making any investment decisions, it is essential to have a thorough understanding of the market. The value of foreign currency is subject to numerous influences and can fluctuate significantly from one day to the next. It is essential for an investor to stay informed about the global economic landscape and to skillfully assess the potential effects of significant world events. It is important to consider leverage, as it involves risking more than the value of your capital. This strategy can result in either significant profits or considerable losses, depending on market conditions. Number 7. Bitcoin. Bitcoin is often seen as a modern alternative to traditional currency, but is it really? During the 2010s, Bitcoin skyrocketed in value, reaching over $6,000, largely fueled by hype and support from prominent entrepreneurs. While there is potential for future growth, Bitcoin's extreme volatility makes it a high-risk investment. Unlike traditional currencies, Bitcoin isn't backed by any government, and no country is obligated to recognize it. Despite its popularity, most businesses still don't accept Bitcoin as a payment method. High transaction fees and slow processing times further limit its practicality. While some believe it could replace debit cards in the future, the current landscape suggests that remains highly unlikely. Number 8. Hedge funds. Exclusivity doesn't always guarantee success. Hedge funds are marketed as elite investment opportunities with high return potential, but they come at a cost. Most require a substantial initial investment, often in the hundreds of thousands, and impose lock-in periods, restricting access to your money for years. Fees are another major downside. Many hedge funds follow the 2 and 20 model, charging a 2% management fee and taking 20% of the profits. While mutual funds offer a cheaper alternative, their underwhelming returns in recent years have made them less appealing. Unless you're an experienced investor with deep pockets, hedge funds may do more harm than good to your financial future. Number 9. Timeshares. This particular investment scheme has garnered such a negative reputation that there are dedicated YouTube channels focused exclusively on providing guidance for individuals seeking to extricate themselves from it. A timeshare can be understood as a method of securing access to a vacation villa for a limited number of weeks each year, often accompanied by a significant premium on the cost. While sales agents may propose that the property has the potential to generate rental income, the reality is that this seldom materializes. Renters are responsible for covering costs related to maintenance, development, and advertising, while agents earn a commission on successful sales, and this amount is significant. It's important to recognize that sometimes circumstances can feel inequitable. Ultimately, it is often more cost-effective to consider renting a different property each year. Number 10. Certificates of deposit, CDs. Timing is everything when it comes to certificates of deposit, CDs, and getting it wrong can cost you. CDs allow individuals to deposit money with a financial institution for a fixed period at a predetermined interest rate, providing a small but steady return. However, there's a major drawback. Once you lock in your money, you can't withdraw it until the term ends without facing penalties. Worse yet, if interest rates rise after you've committed, you're stuck with a lower yield while new investors enjoy better returns. Historically, CD interest rates haven't been particularly strong, making them a poor choice for those seeking significant financial growth. Watch the video appearing on the left side to know the 7 tricks the rich use to build assets. Also, subscribe to our channel to help us complete our goal of 10,000 subscribers.